Alrighty. So in today's video, we're going to be talking about how to be consistently profitable trading options. And I'm pretty sure that this is one of the biggest questions that you have on your mind because I recently just asked a question to my subscribers. I basically just asked them, when it comes to trading options, what is the single biggest questions that you have? And most of the response basically came back something like this. So as you can see, most of the response are something along the lines of getting a consistent profit, consistent income, right? So as you can see the question, what is the best strategy to make consistent winning trades, consistent income, how to grow my account quickly and safely as possible, how to consistently generate weekly, monthly income, how to create consistent, predictable, and scalable income. What a great question. How to make consistent income, cash flow, how to be more profitable, how to generate income the best way, how to achieve consistent profits and income for retirement, how to generate consistent income, basically all about consistent income and reducing risk, which is a very good question, how to get a strategy to get consistent and daily income, and how to have no losing trades. Now this question down here takes the prize, right? So most of the questions down here are asking about how to generate a consistent income, which means to say they kind of already know that there are ups and downs when trading. But this guy, man, this question is the best. This question is on a whole new level, and I really wish I had thought about this question when I first started, right? So this is actually a pretty good question, right? How to have no losing trades. So unfortunately, my friend, as much as I wish that there was a way to avoid losses, I wish I could do that as well. But unfortunately, there's really no way for you to avoid losing trades, because when we're trading the markets, when you're putting money into the financial markets, there's always a chance to lose money, right? Otherwise, everybody will be just putting the money in there and nobody will be losers, right? So instead of thinking how to have no losing trades, what you want to do is to think about how you can reduce risk, right? Like this person have asked, which is a very good question, right? So the whole idea of trading is to not only just generate profits, but also how to manage your risk to a manageable level so that you will not be shaken out of your trade, right? So that you will continue putting on trades and over time you'll be profitable. So that is the most important thing. But if you really want to have no losing trades, then I think the only way, the best way, is to not trade the financial markets at all, right? Rather you just put it into, the US Treasury bills or maybe some government bonds, and then just get the fixed return at the end of the term, right? So that's the only other way. Now, if you manage to find a way to not have any losing trades, please let me know. I'll be the first person to sign up for it, all right? But other than that, there really is no way to avoid losing trades. So what you want to focus on, as what this person say, is to reduce risk. Okay, so let's get into the main question, the main topic of this video, which is how to be consistently profitable trading options. And there are 4 ways that you can do it. I'll be showing you 4 ways in this video. And the very first way is to sell premium instead of buying premium. So when it comes to trading options, there are basically 2 sides you can take. You can either sell premium or you can buy premium. So why do you want to sell premium instead of buying premium, right? So selling premium will always have a higher probability of profit than buying premium. So for example, let's just take a very simple strategy, basically the credit spreads versus the debit spread. So credit spread is basically you receive a credit upfront, whereas for a debit spread, you'll be paying the premium upfront. Right, so an example of this is the short put spread. So as you can see, the short put spread basically is you are selling a put option that is out of the money, and then you're buying back another put, right, slightly further out of the money again. So in the sense where you have some sort of protection at this point. All right, so as you can see, for this strategy, there is a roughly almost 80% win rate for this, because we're putting the short put spread at around 20 deltas. Now on the other hand, you have the long call spread. So these both are bullish strategies. That means if you think that the market is going to go up, you can put on both strategies, right? The short put spread is slightly more neutral to bullish, because as you can see, this is where the current market is. Now it can go down, as long as it does not go down to your break-even price down here, you will still be profitable on the short put spread. But whereas for the long call spread, as you can see, your break-even point is pretty much right at where the current market price is. So this is pretty much, as you can see, a 50 50% proposition, and that is pretty much the best you can get for a debit spread, right? Debit spread, most of the time you get 50% at the best, and then some people like to buy out of the money call spread, right? If you buy out of the money call spread, then your probability is going to even drop even further. So when it comes to selling premium, the advantage you have is that you will have a higher probability of profit, and this is very important because you see, a lower probability trade setup, right, you have actually a longer losing streak compared to a higher probability trade, right? So this is the table where it tells you what is the possibility of a losing streak that you can have. So for example, if you are looking at a 50% win rate strategy, let's say just a simple coin toss, right? Let's say if you were to flip the coin, right? What are the chances of it appearing four in a row hits or tails, right? Four in a row. As you can see, the probability of it is pretty much 100%. That means it is very possible for you to get 4 hits in a row or 4 tails in a row. So if you are actually trading the debit spread with a 50% win rate, what it means is that it's possible for you to just hit this maximum loss at this point 4 times in a row, right? So you're going to go through a losing streak of 4 times in a row. Now if you go to longer losing streaks, let's say somewhere around 7 losing streaks, you can see there still is a 52% chance that you could lose 7 times in a row, right? So imagine you are trading the debit spread. You're trading this long call spread where you're bullish on the stock, and then you lose 7 times in a row. Now, this strategy could be profitable in the long run. That means to say, it could have a positive expectancy. At the end of, let's say, 1,000 trades, you could be profitable, no doubt about that. But along the way, you're going to experience bouts of losing streaks, right? So imagine, let's say you hit a losing streak of 7 times, right? 7 losses in a row. Now, this now comes down to your psychology, because as us humans, we always want to win in a sense, right? So if you have 7 losses in a row, what are the chances of you being able to put the 8th trade on or the 9th trade on, right? You need to have the confidence to place the next trade on. So it's actually very important to have good psychology when it comes to trading. And when you're trading this 50% kind of strategy, while it could be profitable in the long run, you really do need to have a strong psychology to really pull the trigger, especially after losing 7 in a row. In fact, don't even say 7 times in a row. What if you lose just 3 times in a row? What will happen, right? Your psychology will start to say, you start to doubt the strategy. You start to doubt whether is it actually working, is it going to make money, or maybe there's something wrong with your analysis. This is where you start to get analysis paralysis. You start to overthink, and then you cannot even pull, or rather you can't even push the button to enter into the trade. So that's one of the problems of getting into this kind of strategies where the win rate is not that high, right? Especially 50% kind of a win rate strategy. Especially also you can see if you have a losing streak of 10, right? This is out of 100 trade sequence. The chances of you actually having 10 losers in a row is still pretty possible, right? It's 9%. So imagine you hit a 10 losers in a row. You hit 10 losing trades in a row. How is that going to affect your psychology? It's definitely going to affect, because it's going to be very hard for you to place the next trade. So now let's take a look about what about a strategy with 80% win rate, right? So this is pretty much like the short put spread strategy. So you can see for the short put spread, there is also a chance that you could lose like up to 5 times in a row, right? 5 times in a row is pretty big, but you can see the chances of it losing 5 times in a row is only 3%. So that means to say that most of the time you're actually going to be winning. So for example, if there are 2 paths that are going to lead you to the same profitable outcome, which path would you take, right? You're going to get the pot of gold at the end of the day. Would you take the very long and windy road, path number 1, or would you rather take path number 2, which is pretty even, there's not much ups and downs, you still get your pot and gold. So chances are, of course, you will go for the second path, because why do I want to put myself through so much headache just to reach the same kind of results? So similarly, if there were 2 strategies, right, the first strategy and the second strategy, as you can see, both of them achieve the same profit at the end of the day, right? But then for strategy 1, you can see how much volatility that you have to face, right? A lot of ups and downs, losing streaks, and basically a lot of these ups and downs finally before you can reach your endpoint, Whereas for strategy 2, you can see it's much more consistent and much more stable in a sense. And finally, you reach your outcome of having the same results, right? Having the same profit at the end of the day. Obviously, which one you would choose? We would choose strategy 2, and that's where high probability trades come in. All right, so finally, the last key point about selling premium is that time decay is on your side, right? So whenever you're selling premium, we have theta working for you, and this is very important because the market can go nowhere, right? So let's say, for example, you enter into the trade here and the market goes nowhere, right? It stays still, or maybe it goes down a little bit. So in this case, even though it stays still or goes down a little bit, you still make money at the end of the day because you have theta working for you. But if you have the long call spread, guess what? If it stays still or go down a little bit, then you won't be making any money. In fact, you'll be having a loss. Now, you might be saying, Davis, I've already been selling premium, but I'm still not getting the kind of consistent results, right? I'm still not getting consistent profits. I still got a pretty large losing streak. So if that's the case, then you want to take note of the second thing which you can do, which is to trade the expected move. Now, I've already gone to detail in another video about the expected move. You can go ahead and watch that. I'll put the link at the top right hand corner of this video. But for this video, I'll just give a very brief overview about what the expected move is. It basically is the amount that a stock is expected to either go up or down from its current price by a certain time based on its current level of implied volatility. All right, so there's a whole calculation to find out, how to find what's the expected move. We won't go into that, but basically there are two simple ways for you to identify the expected move, and that is by looking at your option chain. And if you can take a look at the number down here on the right hand side, this tells you what is the rough range that the market will make, right? So this is the expected move range, so up 16 points and down 16 points. So basically what you want to do is that you will find the strikes that are up 16 points and down 16 points from where the current market is, and that is the expected move. The other way is by using 16 deltas. All right, so why this is important? It's important because of the fact that implied volatility usually overstates the actual volatility, right? What it means is that the theoretical win rate based on the implied volatility is always lower than the kind of win rate that you're actually getting. So for example, as you can see, this is a study that has been done, and it shows that when you're using the expected formula, right, theoretically, you should be only getting 68% win rate. But instead of getting 68%, what you're actually winning is 85% of the time or 71% of the time. So as you can see, you actually win more than what the theory suggests. Which means to say, for example, if we were to just take a look at this probability down here of this short put spread, it says that you're winning 80% theoretically, right? Theory-wise, you're going to win 80% of the time. But the fact is that you're actually going to win more than 80% of the time because this point down here is based on the implied volatility, whereas realized volatility states that the market will actually move lesser, which means to say that most of the time, the market will be staying within this area more often than not. So that is why your win rate will actually be higher than what is being stated. So that is how you can improve your winning rate, right? So if you've been trading options, you're selling credit spreads that are much higher delta. Maybe for example, you're selling at 40 deltas or 35 deltas. Maybe you want to lower the delta a little bit more, maybe somewhere to around 25 or 20 deltas. So this way you can increase your win rate and your consistency of profit as well. So another studies have been done to show that historically the average realized move always is lesser than the average expected move regardless of the implied volatility level. You can see down here, this is for spiders. You can see when the implied volatility is low, the expected move is still higher than the realized move. So even when the IV is very high, same thing as well. In fact, in all scenarios, you can see the expected move is much higher than the realized move. So again, this means that you will win more often than the theoretical numbers suggest. And this is same for even the IWM. You can see again, the expected move is all overstated compared to the actual move that the market makes. And this is in QQQ as well. So when you start to trade the expected move, you will find that the profits becomes much more consistent because you're going to win much more as well. All right, so the third point is to trade index ETFs. So the reason you want to trade index ETFs as opposed to individual stocks is because individual stocks tend to be a little bit more volatile. So when we are trading premiums, when we are selling premium, we basically want to have the stock or the underlying security that we're trading not to move that much, right? Because we want it to stay in a certain range bound, ideally, right? So for example, if you're going to put something like an iron condor, ideally you do not want the market to move that much, right? Until expiration, you want the price to just stay in within the profit zone so that you can hit the max profit when it expires. So as you can see, this graph down here shows that the stocks are much more volatile than the ETFs. You can see down here that in terms of the standard deviation, you can see these stocks actually move out of their range much more than the index ETF. You can see index ETFs, the small movement range from this point to here makes up the majority of the moves in the market, right? So roughly from 40 to 60% of the time, it's going to stay within this tight range, which is very good for us because we're selling premium where we don't want it to move that much. But whereas for stocks, you can see how volatile it is, right? It moves very wide moves, a lot of these outlier moves, which can cause losses for your trades. So you can see the number of times or rather the percentage of it actually staying somewhere in the middle, where it doesn't move much, is actually pretty low compared to the index ETF. So that is why if you want to have more consistency in profits, trading the index ETFs definitely will help. And the other thing is that index ETFs are not sensitive to individual stock earning moves and company specific news as well. So as you know, individual stocks always release earnings, right? So whenever there's earnings, the market tend to have very big moves, either gap up or gap down. And these are the things that we pretty much want to kind of avoid when we are trading options, right? Rather when we are selling premium. The other thing is that companies are very susceptible to the individual specific news which they have, right? And all this comes very suddenly, right? You never know. So for example, when Disney released the latest movie, the last time, the Avatar, it did not do so well, and all of a sudden the stock really went down, right? It tanked so much, and this moved out of the expected move. So anybody that have any trades on that is selling premium tend to have lost money. And Google as well, recently they released the news, right? Alphabet, their parent company, they released the Google AI chatbot bot, and then because of the ad, there's some flaw in it, right? The answer was wrong. That is why the market saw this as a very bad news, and they started to sell the stock tremendously, and that's where it started to move out of the expected move as well. So when you're trading index ETFs, you don't have any of this shenanigans, right? You don't have any of this funny stuff that's happening. So that is why it's much more stable and much more conservative compared to trading individual stocks. And the final method that you can use to have consistency in your profits is to spread out your trades. So what do I mean? Right, so let's say for example you want to put on a put spread, right? You want to put on a short put spread, and based on your trading account size, you're able to put on 3 put spreads around this area, let's say at the $100 price, right? So instead of putting all 3 put spreads at this price, what you could do is that you can split them up, right? You can split them up to different prices so that it's different deltas. So when you split them up into different deltas, so suddenly you do not have all your eggs in one basket, right? So for example, if you were to trade 3 put spreads just at this point, if the market was to close somewhere here, then guess what? Chances are you're going to be losing on this put spread. But if you were to split them up by different deltas and the market actually goes down here, then you will be losing on 1 put spread, but the other 2 put spreads you'll be profitable. So this way it kind of even out your P&L volatility. Now of course, if the market goes up, right, you will be profiting on all these 3 put spreads, but it's not going to be as much as compared to this 3 put spread at one place, because your premium will be much higher for sure. Alright, so the main idea down here is to remain some consistency in the volatility of your P&L. So remember the chart that I showed you earlier on, or rather the graph that I showed you, where there are 2 ways for you to reach the profit line. So it comes down to which one you want, right? If you want a more rocky, bumpy ride, then you want to place all 3 contracts at that point. But if you want to smoothen things out, make it much more stable and consistent, then you want to try and spread out your trades, right? So one way for you to spread out your trades would be by different deltas. Now the other way would be to split them up by different days to expiration. So for example, you could put 3 put spread, but then one of them could expire, in 30 days, and then the second one maybe 45 days, and then the third one is 60 days. So this way, all 3 of them have different kind of volatility. So when you do it this way, then you want to be also putting all your eggs in one basket, right? Because maybe, for example, the market might come down here at the end of 30 days. So at the end of 30 days, maybe this will lose money. But then after 30 days, in the next 10 days, the market goes back up again. So in that case, you're going to make money on the 45 and the 60 days to expiration. So in this way, although you put them on the same strike, but because you have a different duration of your expiration, then you're in a sense diversifying your risk as well, right? You're diversifying your trades. And the final way is to enter your trades or spread out your trades based on different days, right? So for example, if you decided to put on the put spread, you have roughly, 3 put spreads to put on. You can say right now, you're going to put on 1 put spread. So as the market moves, let's say if the market starts to move down, you can put on another put spread again down here. And then after that, as the market moves up, you put on another put spread again. So against this will be putting your put spread at different strike prices. So there is different deltas. You're putting it also on different durations, right? So maybe, for example, 2 weeks has passed since you put on the first put spread, and then when the market goes down, you put on another put spread. This will be a different delta plus also a different expiration date. Then again, maybe another 1 week has passed, it moved up again, and then you put on the put spread again, a different delta, different strike price, and different days to expiration again. So in this way, basically what you're doing is you're evening out your P&L, right? So you're smoothing things out, so your P&L volatility is not that volatile. So there's a study done by the Tasty Trade team as well. Basically what they did is they wanted to compare what happens if you put all contracts at once versus if you put one contract and spread them out across different days, right? So for example, let's say you have 30 contracts, right? 30 contracts. You could either put all 30 contracts all at once at one time, or you can spread them out one by one across 30 days, right? Sell one every single day. So what this study is trying to do is they're trying to measure, what's the kind of volatility you'll get as well as the end result. So as you can see, the end result is pretty similar, whereby the average P&L per contract all at once is about $35, whereas sell one every day is $40. So it's pretty similar. They're both profitable, and the win rate is also pretty similar, right? One is 82%, the other one is 80%. But check this out. The biggest difference comes down to the volatility of your P&L. You can see the volatility here is $4,000, which means to say there is a huge swing of your P&L. From one time you could be up 4,000, the other time you'll be down 4,000, and the time you'll be up 4,000. But whereas if you were to sell one every single day, your P&L will be so smooth that the volatility is only $150 from each other. And the reason is because when you have different strike prices, different expiration dates, you will have different kind of results for each one, right? For example, this will be a profit, maybe this is a loss, this is a small profit, the other one is a small loss. So it kind of even things out. But if you were to put everything in just one put spread, then guess what? Whether it's a win or loss, it's going to be very big difference because you have everything in one position in one strike price, right? So this is very important to understand, especially if you want to have consistency in your profits. All right, guys, so that's it for this video. I hope this video has been helpful for you. And by the way, if you haven't gotten your free copy of the Options Income Blueprint, then you can go ahead and get it at optionswithdavis.com/blueprint. So if you are wondering still what are the best option strategies that you can use to get a consistent income, then there's no need to look any further because I've compiled the top 3 option strategies that can help you generate a consistent income every single month, and you can just use it to trade, just a few hours a day or even just a few hours a week. So again, if you want to download this, it's absolutely free of charge. Just head over to optionswithdavis.com/blueprint. Last but not least, I thank you for watching. I appreciate your time, and may the options favor you.